The FIFA World Cup is being played on American soil right now, and if you watch the opening round of matches this week, you know what the first few minutes of a major debut look like. There's the energy, there's the anticipation, and then there's the moment when a new player actually touches the ball for the first time under those lights, and the crowd finds out very quickly whether the hype was real. Kevin Warsh stepped into those lights this afternoon, and the verdict from the market came back fast, sharp, and unmistakable. Gold fell nearly 2%. The Dow dropped more than 500 points. The dollar posted its best single-day gain in almost a year. The 2-year Treasury yield jumped a full 16 basis points to 4.21%, its highest level in over a year. This was not a neutral press conference, and this was not a neutral statement. This was a debut that changed the terms of the conversation about rates, inflation, and what the Federal Reserve is going to look like for the next several years. By the end of this video, you'll know exactly what Warsh said, what he didn't say, why it moved markets the way it did, where gold and silver stand right now technically, and what comes next in the days ahead that could either deepen this sell-off or hand precious metals investors a genuine entry point. Let's go through it all, starting with where everything closed today. Gold is sitting in the area of $42.75 an ounce after being turned away from the $43.50 resistance level where it had been hovering all week. That is a loss of nearly 2% in a single session, erasing most of the gains built up over the previous 4 sessions on optimism around the US-Iran ceasefire. It's a sharp reversal, but to keep perspective, gold came into this week in the low 4200s and spent the last few days climbing toward 43.50. Today walked that back. The bigger picture still has gold up roughly 28% over the past year, even with the pullback from the record above $5,500 set in January. So the short-term move is painful if you were positioned for a breakout, but the broader uptrend is not broken. Silver closed in the area of $69 to $70 an ounce, also under pressure, erasing the modest gains it had built ahead of the decision. The key level to keep watching on silver is the 70 to 72 zone that had started to attract buyers. A sustained move below 65 would be a more concerning technical signal. The US dollar index was the biggest single-day mover outside of treasuries, adding about 1% and landing near the 100 level, which is itself a significant psychological zone. On 2-year treasuries, the 16 basis point jump tells you that bond traders are now pricing meaningfully more probability of a rate hike this year than they were when they woke up this morning. Stocks couldn't absorb any of it. The S&P 500 fell 1.21%, the Nasdaq fell 1.34%, and the Dow gave back 507 points by the close. That's the scorecard. Now let's talk about what actually drove it. The rate decision itself was, as expected, a unanimous hold at 3.5 to 3.75%. That much was priced in at roughly 97% confidence. But everything underneath that number was a clear break with how the Federal Reserve has operated under every chairman going back more than a decade. The post-meeting statement, which has typically run above 300 words in recent years and contained multiple layers of economic commentary, forward guidance, and signaling about future moves, came in at approximately 130 words. Warsh called it himself at the press conference, describing it as a bit shorter, a bit simpler, and saying it dispenses with some older language. He put it more bluntly, that statement just gives you the facts, as best we can judge it. What the statement said about inflation is worth noting word for word, because it's the first time this language has appeared under new leadership. It said inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. Then came 5 words that are entirely new to the bottom of a Fed statement. The committee will deliver price stability. Not, the committee expects to return to its 2% goal over time. Not, the committee remains committed to achieving its objectives. A direct declaration, we will deliver price stability. The phrase price stability was not an accident. Warsh used it approximately a dozen times across the press conference. When a reporter asked whether he was reconsidering the 2% inflation target, he was precise. He said, that is the Federal Reserve's long-held objective of 2%. The 2 is the left of the decimal point. For now, 0 is to the right. That line alone was enough to harden the market's expectations. He added that any reconsideration of the target itself would only come after reaching it, not before. And he lamented directly that the country has been above 2% for close to 5 years, calling it a hardship for ordinary Americans that he intends to put in the rearview mirror. On forward guidance, the change was explicit and total. Warsh said forward guidance was not well suited to the current policy conjuncture, and was therefore absent from the statement. In one move, he eliminated the mechanism through which the Fed had telegraphed its intentions to markets at every meeting for years. That's not a subtle shift, that's a new operating system. Ian Lingen, head of U.S. rate strategy at BMO, put it plainly. The statement gave only a cursory characterization of the economy as expanding at a solid pace. Rick Reeder of BlackRock said the FOMC had ushered in a new era of monetary policy in the United States. Krishna Guha at Evercore was even more direct, noting that Warsh sounded a bit like old hawkish Fed Governor Warsh, a reference to his years on the board during and after the financial crisis, when he was consistently more worried about inflation than any of his colleagues. Then came the dot plot, and this is where the market got its biggest surprise. The March projections had shown a median of 3.4% for year-end 2026, implying 1/4 point cut. Today's updated median landed at 3.8%, implying a 1/4 point hike from where rates stand right now. 9 of the 18 officials who submitted forecasts projected rates above 3.75% by year-end, with 6 of those 9 penciling in 2 separate 1/4 point increases. One official still projected a cut. That split of 9 for hikes, 8 for holding, and 1 for cutting is the widest hawkish tilt this committee has shown in years. And as for Warsh himself, he confirmed at the press conference that he chose not to submit a dot at all, exactly as had been speculated. He said he has long-held views on the summary of economic projections, at least as currently structured, that led him to sit out. The dot plot may be among the last of its kind if Warsh follows through on his skepticism of the exercise over the course of his tenure. He also announced 5 separate task forces charged with reviewing different areas of the Fed's operations: communications, the balance sheet, data sources, productivity and jobs, and the central bank's overall inflation framework. He called these subjects timely, consequential, and worthy of a fresh look, and said the task forces would start with first principles, ask hard questions, and ultimately propose next steps. On press conferences specifically, he told reporters that he intends to hold them less frequently going forward, quoting a mentor who told him that press conferences are useful but only when you have something important to say. Perhaps the most telling development of the afternoon didn't come from the Fed building at all. It came from Paris, where President Trump was attending a G7 dinner at Versailles. When asked about today's decision by reporters, Trump said high rates keep the country down, but then added something that no one expected given his long and public feud with Jerome Powell. We have a very good guy over there now. I'm guided by what he wants. That is a stunning sentence from a president who spent years calling his own Fed chair a fool and demanding rate cuts in public statements and on social media. Whether that deference lasts if the committee moves toward an actual hike is an open question, but for now, Trump is publicly standing down. So where does all of this leave gold and silver from a technical and sentiment standpoint? Gold's close at approximately $42.75 puts it back inside the consolidation range it occupied through most of May and early June. The 4,300 to 4,350 zone, which had acted as resistance this week, now becomes the first level gold needs to reclaim to suggest the pullback is over. A sustained move back above 4,350 and toward 4,400 would be the signal that buyers have reasserted control and that the hawkish surprise is already digested. On the downside, the 4,200 zone is the first real support test. Below that, the market's eyes go back to 4,100 to 4,200 and the critical floor near 4,000 that has held all year. Silver needs to hold above the $65 level to keep the intermediate term setup intact. A break lower from there opens a deeper test towards $60. On sentiment, the CME's FedWatch tool now shows traders pricing roughly a 60% probability of at least one rate hike by October, a dramatic shift from before this afternoon, and that repricing of expectations will keep the dollar bid and put a ceiling on gold in the near term unless something else changes the narrative. That something else may already be in motion. Gold began recovering early Thursday morning after President Trump formally signed the interim peace agreement with Iran, which includes the swift reopening of the Strait of Hormuz and the removal of sanctions on Iranian oil exports. Oil dropped toward and briefly below $80 a barrel on the news, and gold climbed back above 4,300 on Friday morning as energy-driven inflation fears eased. That's the key dynamic here. The hawkish surprise from Warsh narrows the path for gold through the rate channel, but the Iran deal closing removes the primary driver of the inflation that led the Fed to turn hawkish in the first place. Those two forces are pulling in opposite directions, and the one that dominates over the next several weeks will largely determine whether gold builds toward 4,500 or fades back toward 4,000. Looking ahead, Friday's formal signing ceremony in Geneva between U.S. and Iranian officials is the next event to watch closely. If it proceeds without complications and oil continues to fall, the bond market's newly hawkish expectations could get walked back, which would create relief for gold and silver. If the signing hits obstacles or falls apart, the war premium comes back into energy and inflation, keeping Warsh's hawkish posture intact and the rate hike clock ticking. Beyond that, the next major data points are June's Consumer Price Index and the July jobs report, both due in the first half of next month. Those will tell us whether the inflation Warsh pledged to defeat is already starting to cool thanks to the ceasefire, or whether it's taken on a life of its own beyond energy prices. Warsh's next meeting is scheduled for late July, and the task forces he announced today will begin their work between now and then, so watch for any preliminary signals from those groups about communications changes or balance sheet direction, both of which carry meaningful implications for how markets price rate risk later this year. Here is the bottom line. Kevin Warsh arrived at his first press conference and did exactly what the man who built a reputation as a price stability hawk would do. He said it clearly, he said it repeatedly, and he let the numbers back him up. Whether you hold gold as a long-term store of value or trade it around events like this, today confirmed one thing for certain. This is a different Federal Reserve than the one that occupied this space 6 weeks ago. The press conference is over, but the era is just beginning. If this breakdown helped you think more clearly about what just happened and what it means for your money, hit subscribe and turn on notifications. Gold's next move will be decided in the next few weeks, and I'll be here every step of the way to walk you through it. Drop your read in the comments. Do you think the Iran deal signing overrides Warsh's hawkish message, or does the new Fed era control the tape from here? Tomorrow I'll break down the Geneva signing and what it means for the inflation story going forward. In markets, first impressions matter, but second acts define careers. Warsh just had his first act. Now we wait to see what he does with the data he's about to receive.